Hello there, this is Kirsty here from Uploads, and today, with the help of my 9-year-old assistant who is sitting next to me, she's like a ghost, and she comes. We have done a little presentation on how it works when you have a construction loan, how the repayments work, because I think it is one of those things that can be a little bit confusing for people. Sometimes people are wondering, how do I pay for my house that's being built and still afford to pay for where I'm living? So whether I'm renting or, living in my previous home, how does all of that work? So what we are going to do, with the help of my fantastic assistant who has done my slides for me today, because she's 9 and she's much better at it than me, we're going to hopefully explain it to you in pretty simple terms. You can refer back to this as a resource. Obviously the figures will change depending on how much your land costs, how much your build costs, but hopefully this will be a pretty good resource for you. So what I'm going to do is I'm going to share my screen, and I'm going to head over to the fantastic slides that have been done by my amazing 9-year-old, and you'll see like there's some pretty cool stuff here that I could never have done, and she's pretty proud right next to me. Thank you, 9-year-old education. So what we're going to talk about today is how do you pay for your house and land during a build, and more importantly, how do you afford to still live while you're doing it, because obviously you can't live in your half-built house. So let's get started. We're going to use a sample build scenario. So for this sample example that rhymes, for this sample build that we're going to use right through the entire presentation, we're going to pretend that your land costs 180 and your build costs 250. Now, I'm living in Launceston, and these are very average sorts of costs for here. Obviously, if you're in another part of the country, the land might be cheaper, more expensive. The build might be cheaper, more expensive, but let's use it as rough examples and then you can go from there. So this is our example client situation. The client is going to have a deposit of $40,000, and then on top of that, we're going to have access to a first home builders grant of $20,000. Now, bear in mind, I'm using that figure because that's a Tasmanian example. I deal with clients in Queensland. At the moment, the first home builders grant up in Queensland is $15,000. So it'll vary. There's also, at the time of writing this and recording this, there's something called a home builder grant, which has very strict timeframes involved. So ultimately your situation will vary to this, but I just want to show you an example. And then the scenario that we're going to work through now is that first of all, they buy the land upfront, but they're not ready to build yet, which is very, very common. Sometimes people will buy their land and straight away they'll work through with the builder, but the quote won't be ready for the build until such time as they already own the land. Very rarely do we do house and land all together unless it's sort of the builder selling the block. So this is a really good scenario to work through because it's very, very common. Obviously, any grant funds for building are not going to be available until you're actually building. You don't get to use them for the land. So that's a really important point to remember as well. So first of all, we're just purchasing the land. And if you remember back, our land cost $180,000. Now, most lenders for just the vacant land want 10% plus costs. Now, I'm all about having easy on the run ways to work things out. So the easiest way to work this out is 15%. Roughly, you're going to need around 15% of your purchase price to be able to get into vacant land. Now, with any sort of rough rules, there's always exceptions. There are a couple of lenders that will go right up to 95% borrowings, which of course means more lenders' mortgage insurance. But ultimately, where possible, when I'm doing the land purchase, I want to try and figure out where am I going to do the build as well? And can I get the person pre-approved for the build at the same time? So quite often, if I'm just doing land, bare minimum deposit that I like to work with is the 10% plus costs. All right, so 15% times 180,000, which is our land cost, gives us $27,000 as our minimum deposit to be able to use towards this. Now, remember as well, this client had $40,000, so they have enough to get in there and buy our land. Now, obviously going in with the minimum amount gives us a 90% loan, which means that they're going to incur some lender's mortgage insurance. And lender's mortgage insurance, I've done another video about it. If you search our blog for LMI, you will get the blog I've done on that. But basically, lender's mortgage insurance is insurance that the bank make you take out when you're borrowing more than 80% of the property's value. And it's not insurance that protects you at all, it protects the bank. All right, and so for those people who'd like to avoid LMI or lender's mortgage insurance, we need 20% plus costs. Again, really good rough rule of thumb is think 25%. So if this person had $45,000, they would be able to avoid using lender's mortgage insurance. Now, they've got more than 27,000, but also to do a build, you need to pay things to your builder. So in this case, they're going to put in $27,000 and keep back some money. Now, this is exactly what I was talking about. Anything you need to pay to your builder prior to council approval needs to come from your savings. So things like soil tests, engineers' costs, builders' deposits, architects' fees, design costs and council approval costs, plans. There's so much, and that's why you want to talk to your builder, because every builder will vary as to how much they need for those sorts of upfront costs. Quite often things like soil tests as well, you want to get done before you buy your land, and your solicitor or conveyancer will give you guidance on that. So there's a handout on our website, and you can go to our First Home Builders Guide here, which is uploads.com.au/stage1. There's 5 stages in full, and the handout there is called Questions to Ask Your Builder, and it's a brilliant starting point, because I always say you do not want to get a block of land, even if you don't intend to build straight away, without talking to a builder, because a builder can tell you like, oh, with this slope, you're going to have extra costs for blah, 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 or there's quite a bit of rock in this block. You want to watch out for this and this, or, you know, have you checked the easements on the block? So a builder will be great in that respect. Also, you don't want to buy a block of land thinking that your build cost will be this and then have it blow out to this. Sometimes that's unavoidable. A lot of builds do blow out, but ultimately it's far more avoidable if you talk to a builder up front. So it's like I've written these slides myself, but how good are these transitions by my amazing 9-year-old, who I pretty much am boring to tears right next to me here, but she's still sticking with me. All right, and so we really strongly recommend that you do not buy any land without speaking to a builder up front, even if you don't intend to build now, because you want to be aware of the rough cost to eventually build. That's the main thing, and any pitfalls to worry about with the block. All right, and so what happens when you just have a block of land? How do you repay your loan? Now, if you have just a block of land and you're not ready to build yet, which is very common, the repayments will be what's called principal and interest on the block and the land. So a principal and interest repayment is just like any other normal loan for a house or anything like that. And what it means is that if you set up your house over 30 years, the balance of what you owe will go down over 30 years' time, and basically the balance of what you owe should go down every single month if you're making minimum repayments. You can, of course, make extra repayments during that time, and most land-only loans will have a redraw function. All right. And then basically, if we're going to just do a land purchase for you, we have to show where you're going to live. Now, there's a lot of words on these slides. Feel free to pause me. I won't take offense if you do. But basically, if you're going to live in a rental property or the home you own now or living with parents, we have to show that to the bank and show how you're going to afford that. Another side note is that even if you're living rent-free with parents, for example, most banks want to allocate what's called a nominal rent for this figure. And if you go to our blog at uploads.com.au and search for the word nominal, you will find a blog I've written on that as well. What it means is that even if you pay nothing and you live at home rent-free, the banks will make you show that if you had to go out and rent, you could pay like a minimal amount of rent. All right, so let's go back to our example situation. Our client was buying a block worth 180,000, and then we ended up with a 90% loan. Now, some of their deposit has gone on costs, so don't feel like it's just disappeared. There's things like stamp duty that we had to worry about and conveyances costs and all of that sort of stuff. Now, let's have a look at what their repayments would be. Now, I'm recording this video towards the end of 2020. Interest rates are what they are right now, and because I'm a mortgage broker, I know that they're not going to be the same in a year if you're watching this, or 2 years. So what I've tried to do is just to give you an example. So right now, if you had a 2.5% variable interest loan, very low interest loan at 162,000, your repayments would be $640 a month. Now, anytime I quote monthly repayments, yes, you can pay weekly or fortnightly, but for ease, I'm just going to keep all the repayments monthly. But if your interest rate was 3.5%, 4.5%, 5.5%, 6.5%. Let's even go back there because I think it's important. If it was 6.5%, you can see that that difference there is just the difference in the interest rate. So that's why having a great mortgage broker is also really important. The first thing a mortgage broker wants to do is find out that whatever bank we're going to is going to approve you for the loan. Secondary considerations are, you know, how well does it suit you, interest rate, all of those sorts of things. But here's just a really rough example so that you can see. And that's a principal and interest repayment, so the balance will go down over time. Now, this is the fun part. Let's add a house onto this, because ultimately having a block of land's fun, but it's 10 times more fun to not just be able to go and stand on your block of land, but to live on your block of land. So let's go back to our example that we had at the beginning. Our land cost $180 and our build cost $250. Now, the client deposit was $40,000, but we've used $27,000 of that on the land. And then in this example, let's say we use $6,000 of that in upfront payments to the builder. Now, we've also got that $20,000 first home builders grant that we can use because we're going in to do the build right now. All right, so we've done our land, now we're ready to build our house. So the really, really important thing to remember whenever you're doing a build is that there'll be usually a deposit that your builder wants to have paid. Now, let's say the deposit's like 5% of your total build cost. So $250,000 times 5%, that's a $12,500 deposit. But remember, this client had $40,000, less their $27,000 for their land, less their $6,000 in upfront payments to the builder. They've only got $7,000 cash left. We're $5,500 short. Now, because this deposit that the builder wants is going to be in the building contract, the bank will pay for that, but not until council approval. And your builder may want their deposit upfront prior to council approval. So this is probably the trickiest part in most builds, figuring out that that builder wants that deposit upfront. The bank don't want to pay it until council approval because that's when they settle on the whole deal, and talking through and negotiating with your builder. So if you don't have a whopping great deposit, this part right here is the trickiest part of most builds, talking to your builder and figuring out when and how that deposit is going to be paid and how you are actually going to pay it. So definitely talk to your broker about ways that we can sort of help work through that. So let's move forward and say, assuming we've now sorted out our deposit, back to our $180,000 land, 250 build. Let's pretend that this is how your builder wants to be paid. There's that deposit, that tricky deposit, and then there's what they want to be paid at the foundation or the slab. Now, remember that your builder gets paid, apart from the deposit, as everything's done. So they lay your slab and then they want $37,500. Now, really importantly to note, most of the time, that's when the first home builders boost actually does get paid as well. So any first home builders grants, anything like that will come at that stage. So what will happen is slab will go down. Typically, the bank will send a valuer out to look at your slab and make sure that it's all good and make sure that it's there and all of that. Then they will let the bank know that that's done. So all of this takes time. Valuation gets ordered, valuer comes out, valuer reports back, valuer notifies bank. Bank then notifies the revenue office, state revenue, about getting your first home builders boost. That comes in, and then with some bank money goes off to the builder. So for this client at this stage, this $37,500, $20,000 of that actually comes from the $20,000 of that comes from state revenue, $17,500 of that comes from the actual bank. But the bank pretend as though they've got that $20,000 first home builders boost upfront. It's a little bit tricky. You don't have it upfront, but the bank pretends as though they do, which means that we can use it as a deposit contribution, which is really helpful. Then when your frame goes up, the builder wants, say, another $50,000. External lining. So, if you have, I'm sitting in my ColourBond house at the moment, that would be when the builder wants that payment, when the ColourBond went up. But for most people, it's like when your bricks are up, basically. And then at lockup and internal lining, they might want another 20%. And then practical completion is those final little touches at the end. The one big thing that I would say is, as you are going through your build, you have to sign off for each of these payments. Be out on site. Be checking things. You're not expected to be the foreman of your own build, but you do want to be checking that if you're signing off for something, you're happy with it, especially that last stage. And that last stage is the most frustrating part for most people because you are this close to moving into your house and you just want to get in there so quickly. But if something isn't done, get it done before you sign off on that stage. Also remember that that final stage is when the bank need to send a valuer out to check everything again. The bank may send valuers at other stages, but always at this stage, they need to check that you've ended up with what the bank said that you could build. It's really, really important. So those are the stages that your builder wants to be paid in. The builder gets paid in arrears. So basically they've got to do the work and then they get the money. And then here's what your loan actually looks like during this. So your initial land loan is $162,000. And these are the stages your builder wants to be paid in. So we've just made it really, really simple here. I'm not factoring in the first home builders boost specifically. I'm just making it really simple. So your deposits added, and then your foundation stage, frame stage, external lining stage, lockup stage, and your practical completion. So there's your end loan of $412,000. So let's see what it looks like when we add in a little bit more information. So during your build, as you're making each of these payments, what we typically tend to do is we roll your land loan and your build loan into one. So instead of just having one land loan for $162,000 and another build loan, you're going to end up with this $174,500 loan. But what happens is during your build, you only pay interest on the outstanding amount so that you can continue to live somewhere else. So at the deposit stage, you only pay interest on $174,500, foundation stage, $212,000, etc., etc. Now, this is the really hard part for people to sometimes comprehend. When we work out monthly repayment rates, we don't work them out based on the exact number of days in the month, because obviously February has 28 days, March has 31 days, you know, that whole thing that you learn when you're a kid about figuring out how many days are in the month. Banks calculate interest daily. So even if you haven't had another draw on your loan, even if you're still at the $174,000 stage month to month, basically your interest repayment might be different month to month. So always make sure you've got enough money in your bank account to be able to make the repayment, not just exactly at what last month's was. All right, my 9-year-old assistant is doing things to the side of me here to stop my fancy light, which is actually another computer going off. It's a very good assistant. All right, so when you get to the practical completion, which is the final stage of your loan, what's going to happen is your build loan is fully drawn. And that stage, you go from paying interest only at the beginning to making principal and interest repayments. So this is the really pivotal part. On this lockup internal stage where you're nearly fully drawn your house, you end up paying, I'm just going to stop my 9-year-old assistant from moving so much in the background because it's distracting me. I'm very easily distracted. You go from paying interest only repayments of $387 right through to principal and interest repayments on $412,000. So let's see what that looks like. So I'm going to use an average interest rate of 3.5%, and this will change. I've just picked a figure that was nice and easy to calculate, basically. So let's have a look. Our initial land loan at $162,000, we were making repayments of $727 per month. And then your builder wants to be paid in these stages. So here, this first stage here where the deposit is, your interest is only $509 per month. So look at that. You're making repayments on the land, $727 a month. As soon as you start making repayments on the build at $509 of interest per month, I'm going to ask my 9-year-old assistant to give that back to me because it's, again, very distracting. All right, so here you go from making repayments on your land down to making repayments on the house and land, a part of it, your interest repayments actually go down. Now, it doesn't mean that you're making repayments on less, but you're not making headway into that loan. You're just keeping it the same balance that it is. And then when we get right down to the last stage, this is more indicative of your final repayments. Now, remember, to keep it easy, I haven't factored in the first home builders boost here. I just wanted to give you a really rough example of what this all looked like here. So interest only, interest only, interest only, right through your whole build until the very end. When it's finally drawn, you make that final repayment, and that's when your interest and principal repayments start. So you're making bigger repayments because you have to then pay that loan off. All right, things that are important to note. Switching from the land loan to the start of the build, your actual minimum repayment will drop a bit. Don't freak out when this happens. It's because you're going from principal and interest to interest repayments. You can pay extra repayments into your construction loan, but be really careful. If you don't have an offset account on your construction loan, typically you don't have redraw from a construction loan. So it's incredibly, incredibly important that you don't put money into your construction loan without checking, because if you do, it can get stuck there. And then right at the end, once your house is all built, have your broker check your interest rate is correct, because if you don't go back and change it from an interest only interest rate, sometimes A, you're not making any headway into your loan, but sometimes you're at a higher interest rate as well. All right, now because my slides were done by my 9-year-old, I did let her go wild and do exactly what she wanted to do at the end. This rainbow unicorn here is perhaps one of the prettiest things I've ever seen. So thank you to my slide designer, my little ninja. And thank you for watching. Hopefully this has been informative. It's not designed to be like oh, now suddenly you understand everything about construction loans, but it is meant to give you a little bit of a guideline as to A, how you afford to live when you've got a construction loan and you're paying for rent as well, and B, just the different stages. As always, go to your broker, ask lots of questions. There are no silly questions. That's what we're here for. And please reach out if we can be of any assistance. We love doing construction loans. It's very exciting to help someone work through that process of finding their land, set up their construction loan. But do remember, there's a lot of moving parts to it. And it isn't always completely straightforward, but that's what we're here for. Thanks so much for watching. Thank you to my amazing 9-year-old slide designer. And have a wonderful day.